Good morning, ladies and gentlemen. Happy 4th of July. I just wanted to do a very quick review of what has changed in the past week and give you my conclusions as to what the direction of the easiest travel for risk markets will be in the next 1 to 2 months. We keep on closing slightly positive and going basically either side of neutral. Those scores are here. We started the week at -8 and closed the week at 10. But what that is doing is actually giving us a very flat look to the moving averages, and what that is saying is that we could have a breadth thrust at any moment, any time in the next 2 weeks. If you look at all the models, the moving averages are coming in towards zero. Where that is happening in the dailies, it's at least 2 to 3 weeks off in the weeklies, and we are right there in the monthlies. So next month could go positive, which basically will mean that the monthly and the daily could easily be positive by the end of this month, and probably the weekly sometime in August, if not already in July. That to me is surprising. Okay, so I'm surprised by how strong the market is. The mathematics at the moment does not warrant it, but that is what the models are saying. And whenever we get a breadth thrust and we start going positive, we go positive for at least 5 to 7%, at least. Okay, so I'm turning more positive as the bad expectations just are not being reflected in price. And I wanted to spend a few minutes on the maths as well, simply because many people have asked me, well, why can't we go higher? We can, okay, but it just certain mathematical truths have to hold for that to happen. So why have I put in 500 days for a return to full forward earnings? Because that is how long I reckon it will take, even if we discover a vaccine in the next 3 months. It has to be produced, people need to be immunized, the supply chains have to be re-established. That takes time. Now, could it be 400 days? Well, it could be, but that's not really the important number. The important numbers, as I said to you last week, are this 160 for the S&P earnings and the multiple of 20. Now, if people get really bullish, could that multiple go to 22? Yes, it could. Okay, there is nothing magical about the 20. We have been up to as high as 23, 24 in normal markets, but it's an extreme. 22 is not so extreme, but we could get there, giving you a terminal price of 3,520 in 500 days time, which gives you a decent yield. So there's nothing magical about the 3,200 level. It's just that we would have to expect a much higher multiple, by about 10%, which at the moment I think is probably not warranted. But, that is what the maths is, and there is nothing more magical to these numbers than that. Now, last week I expected the 2s 10s to start going back towards 35 and give us a buying opportunity off the 35 point. Absolutely nothing. It stuck around the 45, 46 basis points. It had no impulsion to the downside and closed the week right around this 53 area. If we want to get bullish, we have to break 53. It's as simple as that. As soon as we see a couple of closes above 53, we will know that the odds of a breadth thrust in equities has increased exponentially. We will be in a position to start breaking up in equities, as soon as we start trading up here in 54, 55, and then the directional travel is towards 72 to 75. Now, what I found very instructive last week is that I thought I would be able to sell bunds, i.e. Buy the yield of minus 75. We didn't get there. Absolutely, just like in the 2s, 10s, we couldn't go down towards 35. Neither here could we go down, and we broke up and we closed the week basically neutral, right in the middle of the range, but still above the minus 68 point. I still get the feeling that at some stage over the next several weeks we're going to go up, break through 61 and go towards 50. That again shows me that the market is ready at some stage. The risk market is ready for a breath trust at some stage. What doesn't happen is just as significant as what does happen. When every excuse is present for us to go down here and we don't, we stay, and then we break the other way, that to me is significant. It's telling me that there is a lot of demand for risk at these levels, and people are rotating out of safety into risk at these levels. So it's just looking better overall for risk. Certainly that is the message from the bond markets. The message I'm getting from the deviation charts is much the same. We are establishing uptrends. You can see the middle line keeps on rising. We are trading in a very orderly fashion between the middle line and the red line. That to me is a market which is going to establish some sort of a cup and handle and eventually break higher. Every sector that I look at is basically showing support very close by. There isn't a single sector that I can see, not even the worst one like XLF, that is showing that we are going to go into a breakdown. We have support. Last week XLF had every excuse to break down below the center line, and all it's done is basically say that it's going to stick with small variations to the center line and then eventually break higher. This is not the kind of market that we see when things are vastly unstable and when we could get breaks below 29.54. To me, anything in the low 3000s now is a shut your eyes and buy it, and I will definitely start establishing some option positions for towards the end of the year, because I think the direction of the easiest travel is now becoming well established, and just about everything, every component is showing that. I always ask myself, now what would make risk look really, really, really attractive? Well, a much lower dollar would make risk more attractive, wouldn't it? It would just mean that there would be much more liquidity in the world system, and therefore the price of risk could be going higher. It's pretty obvious now that this 98.50 area, 98.37 on the daily chart, 98.54, I mean that's what, 1/3%, who cares, is going to be a wonderful risk reward area to short the dollar. Whether we see it or not, I have no idea. One could start establishing positions even here using any close above 98.54 or 98.37 as a stop loss. We have spent an awful long time establishing this range. I know that looking for a break in the dollar range has been, a real money killer. But it will happen. That's the thing. One has to keep on looking at what the evidence is and basically betting that way. I certainly know that I will start establishing positions around 97.87, and adding all the way back up to 98, 36, 37, hoping for a breakdown eventually in the dollar. Via options is probably the easiest way, and the easiest way in the options world is probably in the Euro USD. And here we have the very important 110.65 level in Euro USD. I think that if we see a test of anywhere close to it, I think it's certainly worth buying. Calls struck around 111 and selling calls struck around 116. If we look at what the monthly chart is telling us, it has, just like gold, these very tight Bollinger Bands, but the tightness of the Bollinger Bands tells me that if we start trading up there and staying up there, and let me enlarge that, chances are that we will start moving up towards this 120 area over the course of 3 or 4 months. To me, that is probably the more likely side over the next several months, and that to me is bullish for risk. Another spread relationship that I want you to be very well aware of and mark down some levels is TLT over GLD. So basically 20-year bonds against the price of gold. Now this line has served me well in the past many times. If I go back, you will see how important that line is and how it's a pivot going all the way back to 2008 when basically it started. I used this line many years ago when this break here occurred. This was very telling to me that we couldn't go back below this line, and then boom, we went up over the course of the next couple of months. We went up percentage points. These are very big moves. Okay, if I take it back to the end, if you have a look, from 120 to 95, what's that? That's 20 odd percent. So at some stage, what I'm looking for is for a breakdown of this line and for us to go back down towards 65. That's like a 30% move in the price of gold against the price of bonds. So below the line you favor gold over bonds, and above the line you favor bonds over gold. What would that tell us? Well, that is an indicator of some sort of inflation risk. Now, whether we are finally going to get some inflation risk, I don't know. Whether the bond vigilantes are going to come in, I don't know. I just know that this is a very important line, and that we are beginning to roll over in this chart, just like we could have said that here back in 2019. We've been in a range. At some stage we're going to bust this range one way or another, whether to the downside or the upside. I think it's more likely that we bust it to the downside. Something that I'm going to look at, 0.936. If we start having several closes below, like we did here above, we will know that it's time to really ship in gold hand over fist. What that is actually saying is, because I don't think the Fed is going to lose control of the TLT, is saying that the TLT is going to remain stable and gold will bust much higher. Not something that I can see happening at the moment or for several months, but something that really you should have in the back of your mind, and a level you should have many alerts set for. Throughout last week, risk did absolutely nothing wrong. It just traded up to level, consolidated, busted through, traded around, busted through, traded around, busted through, a little bit of selling at the end of the week to return positions to normal. And what have we done throughout last week? apart from go up. We've just turned every single moving average back towards neutral. We have the Bollinger Bands where we have them. It's not really impulsive either way. But what it is doing is bringing in these Bollinger Bands, which will create a lot more supports below. It is turning the weekly moving averages, which are now very supportive, around the 3000 level. So not only do we have support there, but we have it at 29.54. By the way, I really cannot see 29.54 busted anymore. And on daily levels, it's basically saying that we could easily trade up to 32.30 at some stage next week, close this gap and try to test the highs. We will probably fail to take those highs out, but then we do a cup, another saucer, give some time, let some time pass, and then eventually go higher. There is just nothing in these risk charts that is saying to me that we have any kind of imminent danger. Monthly chart, this is to me the important one. 30-10, very, very good support. I just can't see too much danger happening here over the next several weeks, unless some amazing news comes out. The path of least resistance after some consolidation is going to be higher, and test of 3300s. That is pretty obvious. Volatility is painting the same picture. You don't know how well you can see it here, but this is the first time that on the weeklies we have actually closed below the previous low, the previous week's low, while the S&P has not closed above the previous week's high. Is this a divergence? No, I don't think it's a divergence, but what it's telling me is that the market is giving up on volatility, is giving up on higher volatility for longer, and which makes sense because realized volatility has been going down, and the market needs to catch up with that. But what is the end result of that? The end result of that is there's more room in the VAR for people to buy equities. We need volatility to go lower if people are going to start buying equities, and I think people are light on equities. The various funds will gonna have much more room to buy equities if we are below 2272 in volatility. To me, that is the absolute magic number. We start closing the week below 2272, a breath trust in equities is imminent. We will have a very violent move higher as people come in and hoover equities at whatever price they happen to be. Now, if we look at the dailies here, you will see the 200-day moving average rising here, and we've got this daily Bollinger Band coming in, just like we have it in the chart of the S&Ps. So to me, it's unlikely that we break over the course of next week. Probably we could even go back to 30, do a reverse cup and shoulders, and then come down. Now, to me, volatility at some stage around here, around the 30, 60 is a big sell, and that is what I intend to play mostly over the next couple of weeks, buying puts in volatility, because I do think that at some stage we break down below this 2272 area, which is so important. Now, it could take several weeks, okay? It could literally take a month, and then we go down into the 20s and into the teens again, and that is going to be the breath trust, because as soon as volatility comes down, the VAR of that the various CTAs and hedge funds and pension funds and God knows what, they're going to come in buying equities like crazy. If you are a dispassionate observer, you cannot but help be impressed by how well the DAX and the stocks held in last week. They had many opportunities to break down. They didn't, and they traded very well. There were no moments of panic, which there normally are in DAX and stocks. No huge gyrations, just a steady progression of bids. Now, to me, that is telling that there is very much support for risk at lower levels, just below the market, all the time. I think that it's probably more likely that we hold in between 12,800 and 11,700, a range for several weeks before we start busting higher. But really, if we now start busting above 12,800 and staying there for a couple of weeks, this is going to be very, very bullish. We could be looking for one more. If you say that this is a one, a two, and a third, we're looking for new highs in DAX, and probably not new highs in the stocks, but it just confirms my view that the right trade with risk is to buy it. The only question is the level and the time. To me, these levels are not particularly good, but on the other hand, they're not awful. And really, it's only recency bias that's holding me back from having a very large position in risk. But as soon as volatility gives me the signal, I will have no choice but to go in heavy on the risk on side. Thank you very much indeed. Happy 4th of July, and tweet you on Monday.